Hi guys, it's CryptoBirb, agent speaking. Welcome to today's Friday webinar. Well, lots been going on throughout the weeks. The local stagnancy on the Bitcoin side after heavy flush, after heavy breakdown of a major long-term support, making Bitcoin fall into an actual bear market with 75% drawdown of the peaks, while stocks are not really seeing any convincing reversal signs. We're going to discuss what is actually going to be potential behavior of cryptos, of stocks in the recession. We are going to talk and discuss the sector rotation, relative performance, and so many more things. If you guys are ready to hear this and more, make sure to stay tuned. We are going there right in a second. Welcome. I hope everybody is doing okay. Please let me know, guys, how you are feeling today. Beautiful weather out in Poland today. I'm recording that a little bit earlier, actually, because the time is going to be played for the webinar. I'm going to be actually on the plane my plane flight to Portugal, because that's exactly where I'm moving out. And I hope you guys have been staying safe lately. There's been some crazy stuff going on all around the world. Double-digit inflation soaring, which is very hard, difficult to stop, apparently, for the Fed and for the other central banks. Well, some major deterioration in the economy, overall slowdown. So we're going to actually discuss whether or not there is a recession coming and what may be the potential behavior. So let's just give it a deeper rundown right away. And one of my often go-to people, for any expertise also in the financial markets, which who happens to be Mike Zaccardi, CFA CMT. You're looking at recession looms XRT, which basically tells you that companies' mentions of trade down jumped in the most recent quarter, right? So the sales of the sales of the firms, of the businesses, is actually going down, and the mentions are actually skyrocketing, right? So this is something I think indicative of and of value in terms of predicting how businesses are operating. And this happens to be also one of the coincident indicators for the actual trade sales. This tells us overall how the businesses are operating in this current state of economy, right? And this basically tells you that if major skyrocketing in spike on the mentions, so many businesses are recording trade down, as in lower sales. This does make sense to actually expect that the slowdown is taking a toll already in the market. This is also coming to somehow correlate with one of the leading indicators of the economy, which happens to be the interest rate spread, right? And we're talking about the yield curve. And here is a chart actually that I had prepared some time ago about 10-year treasury constant maturity minus 2-year treasury, right? So 10-year yields minus 2-year yields, which is a typical setup other than 10 years minus Fed funds rate, to actually anticipate potential recession size. And just like we had it in the past, the recession usually happens, well, typically 6 to 9 months, or a little bit later. It's there's not set in stone rules for it. 6 to 9 months after an actual inversion for the yield curve comes in, right? Which actually has happened if you think about it. We had seen a recording this inversion, as in the difference, the disparity between 10 years and 2 years for the yields, has actually gone negative, right? So each and every single time over the last couple of years, in the last couple of decades, we've seen and recorded in yield curve inversions, mainly coming with with those little kind of like just slips below the zero line, right? So this typically indicates the potential signs of recession, which with coming with an overall tightening monetary policy coming from the central banks is all about to tame very high and difficult to be tamed inflation, right? So this again causes a lot of businesses to slow down. The cost of borrowings become more and more expensive. The high oil and gas prices actually work as a hidden tax, leaving less disposable income from the investors to deploy in the capital markets, which overall leaves us with lower liquidity in the markets, less capital, less volume, I should say also less stability, more deterioration signs. And this is exactly what we've been observing, right? And the fact that you can only add this, trade down spikes recorded by the businesses is also kind of like contributing to this overall picture and giving some confirmatory evidence, if you will. So if we are, I hope you guys can see the screen. If we are to get a proper rundown, through the major financial markets, well, we are talking about the major markets, about Dow Jones Industrial Average, which basically right now, still, is kind of like, at the time of recording, that is not necessarily broken through the major support, which turned into resistance just yet, right? So we're talking about the past support, and namely this very spike, this very, bar, pin bar, if you will, as well, a bullish hammer, which should work as a support, but it instead got broken, right? And the broken support based on the polarity change principle turns into resistance. So if we are to see a proper breakout to the upside, which potentially may give you some hints of reversal, anything longer than a couple of days, then you may anticipate a proper breakout, right? A proper breakout above this fresh resistance level, which actually leaves you not much space, all the way to the local shorter term moving average, right? So once we finally broken, through the main resistance somewhere around and that's approximated down to 3,500s. You're looking at a potential resistance 1,000 points higher, right? So 31,500 is potentially where you may aim for resistance, right? So there are a lot of resistances on the chart. There's a lot of resistances coming from these windows, right? These bar windows, running windows to the downside. This triple gap pattern, actually, what you're seeing, not only, just one gap, you're actually looking at this proper gap, here, here, and here, right? So there are 3 gaps, and each and every single gap and window, if you will, works as a potential support or resistance anchor, and that's exactly, what drives this overall theme, that caps tend to get filled more often than not, right? Depending on the time frame and the volatility of the asset. So accounting for it, we're looking at some potential early reversal signs. However, it's not necessarily confirmed just yet. I like very much that there is this large volume spike, potentially hinting, the capitulation. The volume spikes typically mean the biggest turnaround, right? The biggest turnover, the biggest closure to the transactions, which basically tells you that the biggest amount of also liquidations, the transactions closed and forced to be closed, taken place. So accounting for this huge volume spike and this tiny little, if we were to apply the candlestick chart, you're looking at it as a tiny little small-bodied candle called spinning top, right? This sort of like a candle neutral bar is actually right below, right under this volume spike, right? So the aggregation of the volume and at the same time a small compressed price action within the reversal day is what potentially, adds to credibility if I were to comment to that, right, to the potential reversal signs. However, the resistances are still there, right, and there are some fluctuations towards it, more likely than not. However, still the main resistances conjunction, cluster coming from the short-term average and from this window and from the previous resistance area, it all comes together to actually potentially leave some barriers for the price to encounter first, right? And even if you take it further, for the cyclicals, for the consumer discretion, or you're looking at some local slowdown to the trend, right? The trend is not really sloping downwards anymore strongly. It's kind of like weakening to the downside. Same 3-gap pattern. The downwards trend seems to be slowing down a little bit. However, the distance between the longer term averages, as in the 50 and 200 day, basically increases. This tells you that the market has shifted in the long term, right? Not even in the short term, which it clearly had as well, but it also has changed and imposed larger change to the market, letting the market fall into a proper bear market, right? That's how the bear market is actually kicking in. The energy, surprisingly, is taking a strong toll, is taking a huge, stamp down here and a punt down. This is very interesting. Like I said, before, high energy prices are typically withdrawing capital and drying out the markets out of liquidity, mainly because the work is hidden tax, right? So you pay more, you have, less real income, as in inflation adjusted, inflation is galloping, but if you're still earning the same money, right, then and you're on the payroll, then it basically kind of like, just leaves you in a little bit uncomfortable situation if the currency you're earning in is basically not resistant to inflation, right? So strange environment, and that we are in. The financials, are also down. Healthcare, as a more defensive market, is actually taking local strength, right? This is also interesting. Industrials is another round of cyclicals. Now you can tell, like, if I were to get you guys some proper understanding, I think we can also apply this so-called RRG chart, right? RRG as in the relative rotation graph. And this is basically how it looks, right? So relative rotation graph is an actual way of visualize, just like you would visualize with candlesticks or with bars or with, lines, the relative strength versus relative momentum of certain sectors in the market, right? So if you are to decide about the economy kind of like robustness, you perhaps also want to take it into consideration in terms of defining what your portfolio may be, set overweight or underweight towards, right? So you can clearly tell that the biggest strength right now in the index below belongs to the consumer staples, right? So it does seem that the consumer staples, as in the XLP, remain relatively strong, and the change is the most positive in the price side, right? And RRG actually, like I said, briefly, gives you the clear understanding versus the benchmark. This is the relative performance expressed in the two axes, okay? And then at the very intersection of these two axes actually is the benchmark, which is the S&P 500. So it shows you the relative rotation, relative performance against S&P 500 benchmark, accounting for the momentum, JDK momentum, which stands for the owners, the founders, credentials, right? Julius de Campenaar, I think he's from Netherlands. Very interesting person. Kindly recommended to Google him. As well as the horizontal axis for the JDK RS ratio, which is a relative strength ratio, right? So it shows the relative strength aligned on the right, on the stretching horizontally, and momentum stretching vertically, right? So you can clearly tell and notice that the leading quadrant, the upper right corner, is basically the most favorable position if you're long. If you want to go long or overweight, you basically want to have leading sectors, right? The leading strength where the momentum is strong, when the trends tend to persist, and they tend to operate not only on high performance against the prices, that the prices are doing well, but the momentum wise, okay, there's also outperformance. So when it outperforms the S&P 500 in terms of relative strength in the percentage wise, and at the same time the increase of the acceleration of the prices, right? So the momentum side, then this is exactly what you want to see, right? So here you're looking at, well, first of all, the consumer staples, the basic materials, healthcare, right? And XLI, which stands for industrials. So this is the leading quadrant. However, so far, please note that there's been a little bit of deterioration in terms of the relative performance as the momentum declines, right? You can tell that the relative strength remains strong, right? But the momentum declines. So there has been a little bit of a slowdown in terms of the momentum. The trends are slowly decelerating. They are still very strong, but the overall acceleration is a little bit weaker right now, right? As they are leading towards potentially, a hook turn, anytime sooner towards the weakening parts, right? Hook turn, by the way, is this sharp kind of like twist, the short turnaround, seen as the reversal, right? When a market is strongly performing and all of a sudden, just like you've seen here for the energy, energy had been performing super strongly and sharply, right? The energy prices, like I said, have been very high recently, and it's just recently seen a major blow off, right? Which takes the commodities down, leaving more capital for the investment markets, for the financial, risk on assets somehow. So this is also how you see the strong hook turn, right, which took place here, and the very, the very point right now is actually in the weakening, right? When the momentum is still strong, when the market is still showing outperformance against S&P 500 percentage-wise, but the momentum has weakened a lot, right? Which tells you that potentially the roles may flip, right? And it starts moving towards the next quadrant, which is the lagging quadrant. However, for the improving ones, we're looking at the communications and we're looking at the technology. So a little bit of those cyclicals, right? So a little bit of those cyclicals are actually starting to improve, while we're looking at still relatively still strong defensive sectors, right, which are taking a little bit of a slowdown. So there might be this actual rotation where just defensive markets stop outperforming so much, right? When there are, typically when there's market deterioration, the defensive stocks, which tend to pay out, high yields, tend to be safe investments, usually tend to serve well as a not a hedge, but definitely some portfolio diversification to go overweight, right, towards if the economy is not doing really well. However, you're looking at this local twist, this local slowdown of the performance and on the momentum side, right? So this potentially seems to be this dynamic point where the rotation is the sectors are actually rotating, right? The markets which had been bulletproof, should have been bulletproof resistant, to the economy, despite before paying the high yields, are right now slowing down, and the cyclicals, which are the ones moving with the markets, with the market cycles, with the economy cycles as well, are showing somewhat of improving and more promising potentially setup, getting us maybe to the leading quadrant. However, until you see that in the leading quadrant, which is clearly oriented towards the upper right corner, is not necessarily the best opportunity to go heavily in those. If we were to give this quick rundown also on the OGLC bars, for the futures right now, because the market is not yet open for the spots, you are looking at a potentially promising setup, right? Here, look at an actual moving average here on top, the 50-day moving average. You are looking at a potential bullish divergence, right? First of all, the volume spike, usually happens at the major reversals. So you've recorded for the major volume spike, right? You've had this sudden deterioration in the sell-off. But however, it didn't really add a lot of percentage to the downside, right? You've only seen this 36 hundreds basically kind of like retested, but you're looking at the MACD moving average convergence and divergence, which is a momentum indicator, showing this local not only slowdown to the downwards trend, but also this potential bullish divergence. So this combination of low lows on the price action and higher lows on the divergence not only tells you about this trend, the previous trend slowdown, that it might go expire anytime soon, but it also is promising signal for a potential anticipation for the reversals. Hope you guys can see that still, and that's exactly what I was talking about, the performance rotation, right? So if you on the performance and the sector rotation, this is a chart from stockcharts.com which shows you the sector rotation model, which correlates with the which connects with the relative rotation graphs, right? So one curve is actually the financial cycle, right? And the other curve is a economy cycle, which tends to lag 6 to 9 months behind the financial cycle. Stocks tend to be a form of leading indicator, right, against the economy. If the stocks deteriorate sharply, then businesses are left with less money, right? They have to fire off people, unemployment goes up, and this creates certain deal of issues for the economy itself, which starts deteriorating as well after 6 to 9 months on average. So here you're looking at a situation, like I said, that, the economy-wise, galloping inflation, short tightening monetary policy, hawkish kind of like, ideas of potentially increasing rate hikes, right? We've not only seen for the first time in over 30 years, the 0.75 basis points, in rate hike, but there might be the chances, just like Jay Powell said in the recent meetings, FOMC, that there might be chances that this trend continues, right, if the inflation doesn't stop or doesn't slow down, and it has not seemed to slow down so far, right? So they may continue to tighten the monetary policy even more, perhaps even going beyond 75 basis points, which basically puts us somewhere around this major inflection point for the economy, letting it fall into recession, right? That is an actual anticipation of mine, accounting for all the other metrics on the economy side, on the market side, right? So again, while nobody knows the future, we don't have a crystal ball, right? Perhaps there are some miracles, recovery all of a sudden, and the inflation goes down like overnight. But unless that happens, you're looking at a final stage inflection point of the economic cycle, right? At least for now, and the major sales deterioration, just like we saw in the businesses, is already kind of like, pointing to the inflection point right now. And then when the recession comes in, and then you have an actual sequence of 2 quarters of negative GDP, right? This is where you start deploying your capital in the risk on assets, in the cyclicals like technology, discretionary, services, communications, industrials, right? And the further down the path that the economy starts going to improve after the stocks, that the cyclicals improved, the economy starts to kind of like get back and build back its robustness, right? So materials are going to get a little bit more expensive down the road. Energy is starting to go more expensive. Inflation starts to go up as the businesses, get lower borrowing costs and to overall accelerate the economy, and so on and so forth, right? And that's how the cycle rises and repeats all of the experience. Hope you guys can see that still, because I'm about to give you a quick rundown and analysis for the Bitcoin stuff, right? So how does it all connect with Bitcoin? How does Bitcoin or crypto connect at all with recession? Well, first of all, this is the first major test, I think, aside from the COVID last short recession, flash recession after the COVID crash in March 2020. Later that year, you saw an actual recession kicking in, and like in all honesty, you don't really often see cryptocurrencies to have practiced, a lot of recessive movements, a lot of recession kind of like vibes. So recession is typically where a lot of correlations tend to kind of like change. There's like this market rotation. However, a lot of markets tend to change their correlation. And this is also why I have this bottom indicator in here, which is actually giving me a quick analysis to the Bitcoin USD versus S&P 500 correlation or coefficient over the 7-week basis, which is right now at 0.87, right? It varies from -1 to +1 as the major extremes. The markets can be perfectly negatively correlated or perfectly positively correlated, but it actually happens very rarely, right? So only, in fact, markets tend to get very strongly positively correlated, and the correlation coefficient go to 1 when there is like this black swan event, just like you had with COVID crash, right? So you had stocks going down, you had Bitcoin go down, you had gold go down, which should have been the safe haven also, right? So a lot of uncorrelated markets at the first sight, can actually become strongly correlated when the things go south. Looking at the, from the longer term perspective, we naturally broke out to the downside, just like we said. There's, just like I already said, taking us into a proper bear market, right? So the bear market hadn't really, in my opinion, become the main theme until we recently escaped this major chart pattern of increasing highs and lows, right? We had highs and lows which were kind of like climbing higher until the very breakdown below the main support of $28,000, right? And that's exactly where we saw this major sharp decline last week. Okay, below like $20,000, taking us towards like 17,500, if I'm not mistaken, on some exchanges. And the red curve is actually showing you the 200-week performance versus 50-week performance, which is here on the black curve, right? So we have a very strong correlation to the financial markets, to the S&P 500, to the large caps. So whatever large caps do, whatever big major stocks of the industry do, Bitcoin is supposed to follow on average, accounting for the past 7 weeks, right? So this is the main tendency. And for that, any sharp reversal in the stock market potentially may add confluence and similar directions for the Bitcoin, right? This could provide enough of stabilized environment locally to let Bitcoin get back on its feet again. Right now, we are 75% down, from its peak, 75% drawdown of the peak of the retracement overall size. Well, historically speaking, the bear markets tend to get you somewhere between like 80 and 90% retracement. I think 2017 to 18, bear market bottom 31,200. Basically got 3120 $3,000 basically bottom market floor of Bitcoin 2018 depression. That drawdown peak to trough actually was 85%, 84, 85%, if I'm not mistaken. This is the historical average, right? So anytime the cycle ends, you get a drawdown of 80 to 90% on average. So this also, again, gets you in the conclusion that knowing that there is this theoretical probability, and which you can base on some premise, and at the same time there's historical probability, as in the frequencies of certain occurrences in the past, as in the amount of times, the number of times Bitcoin retraced 80 to 90%, in the bear markets. This is what you have to account, and the more frequency, the more often it happens, the more probability, right? So the probability, the historical probability, tends to point towards 80 to 90% pattern of a drawdown, right? So this is also what makes me a little bit cautious right now. And don't get me wrong, I do think it's still good, better buying opportunity than selling here. And happily for me, I was actually, well prepared in terms of my portfolio diversification, as that's exactly had been my focus until the major turnaround in the markets happened. For the late stage of 2021, I had been aggressively distributing my profits out of crypto to other undervalued markets, right, to precious metals, real estate, and cash. And that's exactly what saved me, right? So I didn't have to pull the plug and just take all in or go all out. For me, it's crypto decision for entries is more of a selection of portfolio assets that I want to hold, right? So I'm not forced. I'm in this comfortable position that I don't need to follow like an all-in aggressive buys or all out, like just, I'm adding consequently or decreasing my exposure to crypto. That's what I do. And that's exactly also after revisiting 200-week average, which historically brought lots of reversals in the past. That's exactly what I do, right? So anytime the assumption was that anytime Bitcoin would touch 200-week average, I would buy that, right? So that's exactly why I've recently bought, 2500s price entry for the long-term investment, right? I still believe there is some little bit of more downside left. Like I said, 80 to 90%, we're 75% down so far. This historically places you within the higher probability of getting a little bit of more tricky situation here, perhaps again some local touchdown somewhere on the previous highs, like $14,000, 15 maybe. You never know that. I don't know that for sure, right? I don't have a crystal ball. However, I do firmly believe that starting to scale in for me, maybe probably more profitable, right, than selling here. So I do believe that it does make sense, at least for me, to start scaling in around those levels. And if I get a proper weekly close around current levels, I would still add another portion and a free entries. And if I get this final capitulation, like I said, this towards like $14,000, this final kind of like a flash taking us to the 80-90% range of retracement of drawdown, that's exactly what I've deployed my last chunk of capital for Bitcoin. Okay, hope it makes sense, guys, for you so far. And taking us a little bit closer down to earth on the short-term view, medium-term view, the 12-hour chart is what I keep watching, as you know very well. And the trend following breakout system is what I deploy as my near-term portfolio strategy, aside from my long-term portfolio strategy. Right, so my long-term capital is this sector is different, put aside, completely independently from the nearer term investments. And this happens to be the position trading for the breakout trend system that I use, which happens to be the Bear Pro. And well, this basically tells you that the market is starting to look promising. You're starting to see a lot of more orange theme, which is bullish here. However, the main threshold to be broken for the trend breakout validation still remains open, right? So I want to see, in order to deploy short-term capital and open Bitcoin positions in the short term, regardless of the long-term choices, I want to see a breakout above the clear threshold, which happens to be 23,141, right? So the moment I see a daily or weekly close above it, I would argue that this would make pretty decent trigger for my trend breakout system, right? I hope it makes sense, everybody. And well, until I see that the bears are in control, that's how you kind of like should interpret it. It's not necessarily about the market itself going up or down, but the tendency, that the robustness of one side prevailing over another, right? So the bears have had the upper hand ever since Bitcoin lost basically $30,000. That's exactly where it started to deteriorate, right? And it started to deteriorate, like I said, before it happened, right? So this happened to be like a warning ahead of the crash, which luckily for me basically saved me from 50% drawdown on my capital if I hadn't applied stops. Right, I got some loss. I got chopped. The system gets chopped, in the sideways because it's trend promoting. Sideways is against trend. Sideways is basically not a trend. So anytime you get sideways, it chops you up. You get a lot of fake signals and fake triggers. However, when the larger trend develops, just like you see here and here, you profit from it, covering for all the losses and making it a very profitable situation. So unless I see a proper breakout above 23, make it 200s, I'm not deploying my short-term capital. For sure, it's still cashed. And if I were to give you a deeper context for the crypto and how it's all performed over the last 173 days, which is exactly what we're looking at right now, right? Ever since the 2022 started, then you can clearly tell that there's an entire clump and congestion of the top market cap cryptos, which are down from 50 to 75%, right? The worst performing one happens to be, if I'm not mistaken, BCH, which is seems to be pretty obvious, 75% down. There is also, if I'm not mistaken, again, there are lots of those colors. You can choose different bases for that. However, TRX on the top seems to be the best performer, right, in 2022 over the top cap coins, which is pretty interesting, right? And recently, over the last couple of days, it's actually decreased its decline as an increase relatively, while the majority of the other coins stayed down, right? So including Bitcoin, which is in the red here, about 55-60% downwards this year. Well, then it clearly tells you that there's a clear differentiation between TRX and the entire clump of other kind of like coins. It's pretty interesting. It's pretty interesting phenomenon. However, that's worth accounting for. And the 50-75% retracement is what you're looking at the top major caps only this year, right? So this tells you about the performance of cryptos. And I do hope, guys, that it does make sense so far. Right, there has definitely been tons of points that I've already introduced, as in the recession signs, how to anticipate a recession, including leading lagging indicators. Lagging indicators, maybe also there are a couple of lagging indicators that if you were to name a couple, right, for the lagging indicators, then you would basically look at the inflation as in the CPI. You would look at the consumer debt, versus the personal income, the manufacturers' inventories towards the sales, inventories to sales, right? If the inventory is high, inventory to sales ratio is high, then it tells that lots of businesses did not manage to sell their inventories, right? So there's a lot of stuff still remaining, not successfully sold. Besides, you do have the total consumer credit owned, and total unit labor costs, right? So the more expensive it takes to hire people on the payroll, right, for the manufacturers, you're basically looking at a very recessive themes, right? So all those things concerned, the market has short-term promising setup with potential bullish divergence shaping, and if no fundamental change happens in the markets, this may take us in the potential promising upwards direction. However, for Bitcoin, you need to account that the majority of the coins are 50-75% down this year, right? There is a clear underperformance in those terms. And even if we add to the relative rotation graph, there's Bitcoin Bitcoin USD, then it clearly tells you, right, where Bitcoin is against the other stock sectors. You can clearly tell, right, that the Bitcoin is in the worst possible situation in terms of the momentum, and it's outperforming the momentum in terms of relative strength, and underperforming again versus relative strength, and underperforming against momentum. right? So with the S&P 500 anchored at the very here in the section of the axis, you're looking at Bitcoin, which is both weaker on the momentum side and on the performance side, right? So again, this tells you a lot, I think, about how far crypto are, from the inflation hedge, from the recession hedge. This overall needs to be accounted for this time, at that time, as risk on assets. So because of strong correlation with crypto, between crypto and stock markets, large caps S&P 500, you're looking at kind of like a confirmatory bullish signal for Bitcoin, bullish environment, should I say, whenever stocks turn up, right? So all those things concerned and so many main points, to be mentioned. And that's exactly what I keep discussing on a daily basis, along with my beautiful team, 24/7, with the full coverage in the premium corners of the Burb Nest. The Burb Nest is the educational platform, premium platform for education investors. Ever since 2017, right? We've been educating many different investors since 2017, serving hundreds of countries, tons of amazing values, 24/7 chats. That's exactly what is going to save you lots of time, money, stress, nerves, and basically potentially may help your portfolio grow more steadily. So if you guys want to get some insights into it, I get 7 days free access for you, right? The only thing you have to do, you can go to for any time you like to theburbness.com, go on and sign up free on the top upper right corner for the sign up free button. Get us your email, get us your name, and you're going to get set up automatically within a couple of seconds, not wasting your time, no charge to it, no credit cards required. No obligations, no strings attached. If you just want to learn for 7 days free, then we've got this offer standing up for you. The only thing you have to do is to go to theburbness.com/free -trial, or basically go to theburbness.com, click on the free trial, sign up free button, and we're going to set you up, guys, for any market 24/7, regardless of the country. You're going to feel like home, and I'll make sure of it along with my team 24/7. That's all, folks, I've got for you. I see you guys in the nest with all your questions. Leave some kind comments if you watch that on YouTube. Subscribe to our channel, hit the like thumbs button and notifications bell so that you don't miss out on the rest of our content flowing in daily to feed your brains with insane knowledge. Guys, hope you enjoyed that. God bless you all, and I see you around. Cheers.